XN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
You are listening to the Financial Survival Network. I'm Kerry Lutz. The date is June 7th, 2016. So, talk a lot about real estate, about the deals to be had, about safety, about continuity of income, stability of income, cash flow. But one thing we really don't get into much, and we should, is how to analyze a deal, how to look at a pro forma, find the important numbers on that pro forma, and make a rational decision based upon the numbers. We don't want to bore you with a lot of numbers, but I've got Jason Hartman here. And Jason, you're the expert in this. You could do this in your sleep. So welcome back, as always, first and foremost. And hey, how hard is it really? Do you need to be a numbers guy to figure out whether a property works or not?
No, you don't. I'm happy to say, Kerry, this is not that difficult. And I just got back from 2 property tours. I saw you on the beginning of one of them, and that was about 3 weeks ago, I guess, in Jekyll Island, Georgia, the birthplace of the Federal Reserve. I took my mastermind group, my Venture Alliance mastermind group, and you came along as a guest for that trip since you're not too far away. And then the week and a half following that Venture Alliance weekend in Jekyll Island, I toured Florida and spent a lot of time touring different markets in Florida. And then just the night before last, I got back from Ohio, where we did a property tour in Cincinnati with about 3 dozen people. And they are both so educational, you know, going around the country, seeing these properties all the time, as I do. It is very educational. And I'll tell you something, when I started being a nationwide investor 12 years ago, and I had to form my own company to basically just be my own client. My story, you know, some of your listeners have heard me on the show before. Certainly, we've got some clients in your group that, by the way, we saw one of their properties over the weekend on our property tour, and that is Karen's property, by the way. Hi, Karen, if you're listening.
Heads up to shout out to Karen. Been with us listening forever, just about, and somebody who's actually gone out and done what you've said, Jason, and she's on her 3rd or 4th property now, if I'm not mistaken.
Yeah. She and several of your other clients are buying properties through our network, and we thank you and them for their business. And it's just great to see. But one of the things is you know, I had a traditional real estate company in Southern California, and I was always a local investor. And I thought, you know, as I started negotiating a deal with Coldwell Banker to buy my company from me, I thought, I'm going to have a big check here. I got to invest this money. And I don't want to be a victim, again, of not being properly diversified. I want to look at the entire world and then the entire country as my stomping ground as a real estate investor. And being a big international traveler, I looked around, toyed with that idea, and dismissed it rather quickly. The U.S. has a pretty special real estate market when you look around the world. I'm about to visit my 80th country. That'll be Fiji. I'm visiting in just about 2 weeks here. I'll be there. And you know, I started looking around the U.S. and researching all these different real estate markets. And Kerry, one of the big problems with real estate investing is that it's so fragmented. Everybody in these different locales does things differently. Everybody even in the same locale does things differently. Mm-hmm. And it's all very fragmented. And that can become very frustrating for investors. I know it was very frustrating for me as an investor. And I went around talking to real estate people and builders, and I just couldn't get any good data. I couldn't get half the time I couldn't get a return phone call. And I thought, what do they think? I'm not serious? I mean, I have money. I can give them a bank statement, a pre-qualification letter, no problem. And it's amazing how lame this industry is, to be very honest with you. It's just really a kind of a lame industry, but it's got a great product. You know, What'd you say?
It's a little disheartening to think about that.
It is. But, that's why there's opportunity. The fact that it's fragmented, the fact that everybody does everything so different, and so many of the players in real estate are so frankly lame. I'm just going to say it. They're lame. They really are.
Oh, God,
and that's why there's opportunity, because you can come in, any of you people listening can be a more knowledgeable, more sophisticated investor. You learn how to analyze a deal, which is not difficult, by the way, and you have a big advantage, being that educated person. And so today, let's talk about one of the first things I did 12 years ago, and that is data standardization. You must standardize the data. The data has got to be standardized. That's the very first thing you got to do. So right now, if your listeners want to see any of these performas, they can just go to jasonhartman.com, click on the Properties tab at the top, navigate to Properties, and then look at these performas right on our website. And before we started recording, Kerry, I just picked 2 random properties off the website, and I sent the PDFs of these performas to you so we could go over them together.
Great.
And teach your listeners how to analyze a deal so that they don't get burned. So let's look at one.
Yeah, and we'll make these PDFs available to you. I think there's a way to do it. If not, just send me an email, kl@kerrylutz.com. I'll shoot you out the PDFs. They got a picture of the property as well as a full financial summary. It looks like, Jason, I'm looking at this pro forma year one projection for property. I guess we'll do the one in Florida first.
Yeah, we can do Port Richey, Florida. Now, this is a market I just visited a couple of weeks ago. Look at this property. I mean, Kerry, you're looking at the picture. That's a nice like lower middle class house. And lower middle class is exactly the kind of properties we like.
Blue collar, working class.
Yeah,
I would call it
working class type areas. Yeah. So that's great. And
it's not the Taj.
Some of these homes are 3-bedroom, 2-bath. Some are 2-bedroom, 2-bath. They span the spectrum, and in different markets, different things are appealing. But look, this property, I mean, let's be realistic. It's only $84,900, $84,900, and it's $78 per square foot.
Your car costs more than that, Jason.
Yeah, well, many cars do, but try to limit your investments in depreciating assets and get a lot of appreciating assets.
Yeah, I'd rather have this house than your car, honestly. As much as I love your car, this does more for me.
Well, I agree. More. And, I've got a bunch of these houses and I got some apartment complexes. And so I did recently decide to buy a Tesla about 6 months ago, and mainly for the self-driving feature, which we've talked about before, Kerry. So cool. I think that's going to be a game changer. But you can text and drive safely. I'm with a guy the other day, Jason. But not legally. Yeah, well, my friend Jack, he's got a Tesla, and he had brought it in for service. So he had another Tesla, a loaner. And he throws it into auto drive, and he's like texting away. And I'm like, okay, what are we doing here? It was a nice car. A lot of road noise on it, surprisingly enough. That surprised me, but comfortable. Really? I didn't think so. I think my car is super quiet, but I don't know. Yeah, it's compared to my Lexus, it's a lot noisier, but it is a great car. And Kerry, I've recorded podcasts while the car is self-driving me from Scottsdale, Arizona to San Diego, California. Yeah, now if I could just do that in my sleep, I could make a fortune here. But sometimes people do say that I'm doing it in my sleep, and for that I apologize. But looking at this, it's $85,000, $84,900. So obviously your purchase price is a relevant number, right? Yeah. So we're going to try and go through 2 properties on this podcast episode. One is in Port Richey, Florida. The other is in Hamilton, Ohio. Okay. And both very nice areas. We've got other areas around the country that we recommend, whether they be Memphis, Atlanta, Indianapolis, whole bunch of others, whole host of areas that we have vetted and like, and our clients are buying in. But this one, basically with 25% down, your total cash into this property would be somewhere about $24,000 with closing costs. So $24,000. Projected rent is $975 per month. That's pretty good too, by the way. What's that?
That is pretty darn good.
Yeah, it's better than 1%. Yeah. That rule of the RV ratio, the rent to value ratio, should be in the neighborhood of 1%. And as your listeners probably know, if they've heard me on the show before, those rent to value ratios are declining. Frankly, it's getting worse because the prices are going up, and the rents always lag the prices. It takes rents a while to catch up with prices. So this pro forma includes everything. It includes your projected vacancy rate, appreciation, management fees, and projected maintenance costs. So here, $975 per month projected rent. You've got all your expenses there. Taxes are very cheap in this area. Insurance is fairly cheap. Management fees, maintenance costs, and we come down. If you look down the left side, let's come down to your cash flow projection of $365 per month, or $43.87 per year.
Wow.
And yeah, it's looking pretty good, right?
That's looking
But wait, there's
good.
More, as they say, right?
There's more.
Yeah, exactly. So with a mortgage of 75% of the value of the home, your debt coverage ratio, let's move to the right side of the pro forma
now.
That's
an important number, too.
Yeah.
Very
amazing, isn't it?
Number. Yeah, God. Because you look at, when you analyze companies, their debt, you look at their coverage ratio of cash flow to debt service. And obviously, the higher the number is, the better. And this one is 2.13, which is, we don't see that many in your group, and they're all fitting into a certain criteria. That these numbers are really good.
Yeah, it's pretty darn amazing. And income property has multi-dimensional areas in which you earn your return. And that's what makes it work so well. That's why it's the most historically proven asset class in the entire world. So the debt coverage ratio, really what that means is how likely is it that I'm going to get into trouble with this property ratio? And if it's 1, that means you're just covering your debt. It's even, right? But here it's 2.13. That's phenomenal. I mean, that debt coverage ratio gives you a lot of room to make mistakes or have misfortune. So if you have some misfortune, if you make some mistakes, if you're really bad at management, gosh, well, you got a lot of buffer here.
Let's put this into better perspective, at least in my opinion, more relatable, because your debt coverage ratio is 2.13 to 1. That means that you can still cover all your debt costs if the property is vacant 6 months of the year, right? You cover
pretty
your debt.
Much, yeah.
That's what it tells me. Yeah. So that's a good position to be in, because even if you lose a tenant, you're out for a couple of months, 3 under the worst circumstances. You're still not going to have to reach in your pocket to pay that mortgage, in all likelihood, right?
Yeah, you're going to be in pretty good shape with a property like this. So debt coverage ratio looks fantastic. Now let's drop down to cash on cash return. Cash on cash return.
My favorite number. That's my favorite number, Jason.
Kerry, there's good reason that should be one of your favorite numbers. It's your favorite, but it doesn't show the whole picture. It's actually better than that when you look at the whole picture. But here's what cash on cash return tells us. The cash on cash return is a really pretty conservative number, because it basically says that, look, as long as you maintain the same income and expense ratio on this property, and income is pretty reliable. Appreciation, however, is not very reliable.
No.
But if you can, we say of my 10 commandments of successful investing, commandment number 5 is thou shalt not gamble. In other words, don't expect anything big to happen for you to make a nice return on your investment. In other words, don't expect any appreciation whatsoever, or at least not any major appreciation. And so if you don't get any appreciation, in fact, if the property value declines, but you maintain the same income and expense ratio, you're going to get, this is one of the highest cash on cash returns I've seen in a long time.
I don't remember.
19%.
19%. That's huge. And if you use the rule of 72, and and you divide 72 by 19,
you're going to double really quickly. Yeah. I don't have the calculator, though.
I got the calculator. I'm doing it right now because I opened my mouth. 72 divided by 19, you are going to double your money in 3.8 years. Call it 4 years. You're going to double your money. You can't do that any other place except some hotshot sector in the stock market.
That's called getting lucky. Yes.
Yeah, right. That will probably lose you money because you won't get out at the right time. Mm-hmm. And the other thing here, Jason, I want to point out, you've got a first-year principal reduction of $1,000.
Yeah.
Okay. So, I know you like leverage. Once you go 5-10 years here, you've paid off a substantial portion of the mortgage. You play the refi till you die game. You pull money out of the property, and that you can use to buy other properties or live on, or whatever your financial plan is for your future.
Yeah, this is the most historically proven asset class because it's a multi-dimensional investment, and you get returns from a lot of areas. So. This may sound crazy, and the next number we're about to share with you, you may actually think, is this guy actually credible? This sounds way too good to be true. And you know what I say? Look, if it only goes half as well as what we're saying on this pro forma, then you're still doing phenomenally well. Okay, remember Bernie Madoff, his big promise to people, he had the second largest Ponzi scheme in U.S. history, the largest being the one he said he got the idea from, which is the U.S. Social Security system.
Yeah, you can never go wrong emulating the U.S. government, right?
You're right. Well, the government-sanctioned Ponzi scheme, they don't get in trouble for that, right? Yeah, Only right. Bernie gets in trouble. Mm-hmm. But anyway, Bernie was a crook, right? Yeah. And a crook with a great resume. I mean, he was president of NASDAQ. He was Wall Street. If you rely, when you're investing in someone else's fund, another thing I say is don't invest in funds, don't invest in pooled money assets. Be a direct investor. That's my commandment number 3. Thou shalt maintain control. Buy your own stuff and control your own stuff. And so anytime you rely on someone else's resume, I mean, I'll just give you 2 as an example. Number 1 is Bernie Madoff. Until he came clean and everybody knew he was a crook, his resume was about the best in the world.
Stellar.
Okay, stellar. Perfect. I mean, you could have done a background check on him and he would have passed with flying colors. And the next one would be, and Kerry, you've talked about this on your show before, John Corzine, right? MF Global. I mean, he was governor of New Jersey. How does your resume get much better
senator,
than that?
United States senator.
I mean, yeah, seriously.
But it's okay because he's now in charge of Myra for the U.S. government, so you don't have to worry. He's learned all his lessons, right?
Oh yeah, exactly. Yeah. It's you do bad things in that world and you get promoted. It's absurd,
pretty much.
Well, hey. Look at Hillary Clinton, the criminal that she is, right? I mean, it's disgusting. But that's another topic, lest we go off on a tangent.
Yeah, let's not.
So when you look at all of the multidimensional aspects in one, when you look at income, when you look at principal reduction, when you look at tax benefits and leverage, all of those things combined together, this property has a projected return of 45% annually. And by the way, these are annual numbers. Mm-hmm. So the cash on cash return projection at 19% is an annual number. And I don't know if I finished my thought on Bernie Madoff. His big promise to 10%. Investors was, can you get 8 to 10% consistently? And that attracted $55 billion to him, billion with a B.
Yeah. Well, so, I have 2 Bernie stories, if I can quickly tell them.
Go for it.
Okay. Number 1, my friend's uncle is managing partner of a very wealthy firm. They managed, or they represented, Madoff, and they created a feeder fund for the firm's retirement account and for all this other stuff. And this guy was really well off. Now he works, last I heard he was working part-time at Macy's, and had to sell his house in a really nice area and move to a lesser area in Lake Worth, and his wife's money was tied up there as well. They couldn't go to SIPC because it was a feeder fund and they were not covered by Securities Investment Protection Corporation. And the other one is my architect. Now, this was about 20 years ago. I was going to buy another house and redo it. And he said, I'm having lunch with him. He said, I just, I'm doing architecture now because I really like it and only doing projects I want to. Because I make money, in a bad year, I make 8 to 10%. And in good years, I do even better. And guess who his financial advisor was?
Bernie.
Two people I know really well.
It's amazing. Yeah. My ex-girlfriend, her in-law, her parents-in-law, her mother and father-in-law had a couple $1 million with Bernie Madoff, and they lost it all.
Yeah.
So, yeah.
It could ruin your day. I mean, you did have the ability to carry it back 3 years so you could refile your tax returns, but hey, nobody wants to do that. And here, you could at least go and look at your asset and see that it really exists.
Yeah,
otherwise
it's yours. You own it. You control it. You know, it's your thing. It's not someone else's. You're not leaving yourself susceptible to the three major problems when you invest in someone else's fund or someone else's stock or bond or business or LLC or anything. Right, and those three major problems are: you might be investing with a crook, you might be investing with an idiot, and if they're honest and competent, if you pass those two hurdles, they take a huge management fee off the top for managing the deal.
Yeah, of course. Yeah. So we look at the next one here.
Okay.
It's a property in Hamilton, Ohio, 3-bedroom, 2-bath, 2,329 square feet.
And Kerry, would you say that's a great looking property?
Really nice looking property, and higher end than the other one. I would say this is a solid middle class neighborhood.
Sure. And this one is only $57 per square foot. Okay, so that's below the cost of construction. If that house was to burn to the ground and the insurance company was to pay out to rebuild that house, they would probably have to spend about $80 per square foot to build it again.
Oh,
so
easy.
You're in very good shape there, and that's a good little insurance, is that cost per square foot metric. We didn't talk about that last time, so I wanted to mention it. So let me run through the numbers on this one. 132.9, 2,300 plus square feet. At 25% down with closing costs, it'll cost you about $38,000 to buy it, and projected rent is $1,245. And your projected cash flow every month, $259 or $3,100 per year. And Kerry, what's the debt coverage ratio on that one?
1.5 to 1, basically.
Yeah, 1.51. Pretty good. Pretty darn good.
So it means it could be empty for 4 months of the year, and you're not going to have to dig into your pocket.
Exactly. And cash on cash is not nearly as attractive as that last one. That last one was a real anomaly.
That's extraordinary. The other one really is.
Yeah.
I mean, that,
most of our cash on cash returns are somewhere in the 8 to 12% range for cash on cash.
Yeah.
Assuming there's no appreciation. Property value drops to half, and it could drop to zero. Just maintain that income and expense ratio, and you got your cash on cash return. No ifs, ands, or buts.
Yeah, I'd say like a predominantly large number of your deals are 10 to 11, 12% that I see. And that doesn't mean that this isn't a better deal for other reasons, because the area is more stable. It might have better potential appreciation, although we're not buying for that. A lot of things factor into this. You'll probably get a better quality tenant here. I'd almost be willing to bet. It's just a much more attractive property.
Yeah, but that other one is not unattractive. I mean, that's a nice looking house. I've been to that house, actually, other one.
I know those houses. Yeah. Believe me, they're all over Florida. And, it's, not so much hurricane stuff in Tampa. There's a lot of pluses to that first house. And don't forget, no snow removal. Your paint lasts longer because you don't have snow. No basements in Florida. So the simpler maintenance of a house. You don't have a furnace. You have a small hot water heater. You have air conditioning with a heating coil that gets used 2 or 3 times a year. The mechanics of a Floridian house really play into your investment theme. In some ways better than, any place else without the hurricane exposure. But in Tampa, not so bad there.
Okay, so on this one, overall return on investment, Kerry, I mean, how's that number for you?
I find it pretty darn good. I mean, even with everything, and we're not talking about any tax advantages or anything else that you might be able to achieve. Just
combining cash flow, leverage, appreciation, mortgage pay down, your return is projected at 33% on that one.
Yeah,
I mean, 33%. Yeah. Even if it only goes half as well as expected, okay, and you make 16.5%, still pretty good, right?
Yeah, and let's not forget that you're building in an 8% vacancy rate, which basically is 1 month, right. And you're reserving for maintenance. We got a monthly 5%
reserve. Of the income.
5%. Yeah. So, hey, maybe you'll need it, maybe you won't. That all depends. But and maybe you'll get lucky with a tenant and maybe you won't. But the point is, this has all been considered in your normalized formula. The process you were talking about, getting standardized data, that's called normalization. It's exactly what Yahoo has done with company balance sheets, although the problem with when you're using it with publicly traded entities is there's all sorts of games and there's all sorts of gaps that won't be picked up by the normalized numbers. This is a whole different ballgame because these numbers are the same no matter whether you're in Cincinnati, Ohio, or you're in Port Richey, Florida. The numbers are the numbers.
Yeah, absolutely. And you could be in Memphis, you could be in Indianapolis, anywhere. You could be in Dallas, Houston, you could be in any of the markets we recommend, and it'll work. It could be Atlanta, doesn't matter. We've got the standardized pro forma. You can see all those at jasonhartman.com/properties, and just take a look for yourself. And I'd encourage anybody listening, just go to our website, jasonhartman.com. And be skeptical. Tear it apart and ask us questions. Listen to my podcast where I talk about this stuff in detail. We have a lot of clients on the show. You can hear their stories. We've had some of the same clients for many, many years. They get addicted to this real estate stuff, and we're glad they're addicted. It's like having a Starbucks, right?
Yeah, for good reason. I mean, my favorite story is about Fernando, who had a high-paying job at Apple, and
left it
and chucked it and bought 70, 80 properties, and now he works for you. Yeah. That's the best story I ever heard, the best endorsement you can get. Over time, I just realized, Jason, that I've done the best on real estate, and not because I knew what I was doing at all, just because, like you said, favorite class, better tax benefits, which we didn't even factor into this equation, and like you said, the best performing asset class over probably a century's time.
Yeah. It's like you alluded to the taxes. Taxes are the single largest expense in anybody's life, and income property is the most tax-favored asset class in America. Yeah. So it's pretty darn good, folks. Check it out. You can listen to my podcast, of course, at jasonhartman.com or any podcast platform. Just type my name, Jason Hartman, and you'll find it, The Creating Wealth Show. And we've almost got 700 episodes up. Not as many as you, Kerry. You're a behemoth in the podcasting world. But
anyway, just go over to jasonhartman.com. Check it out. If you want to learn more, there's a course there, and send Jason an email. He'll help you out on that, but he'll get you started, and you can start doing this stuff the right way. My only regret, Jason, is I didn't start with this sooner, and I got a whole reason why. That's
everybody's regret.
That I will tell you later, because I came from a real estate family. My father believed in it greatly, but I didn't know enough. And if I had a platform like yours to learn it from, my life would be totally different now. Not that I'm regretting it by any stretch. So jasonhartman.com, And as always, you can find a link to Jason's site on financialsurvivalnetwork.com. We've got scores of Jason's episodes posted all over the archives and on the current pages. His podcast is great. We talk about a lot of the same issues, and Jason brings his own unique perspective to it. So jasonhartman.com, financialsurvivalnetwork.com. We will talk to you again real soon, Jason. Be well.
Thanks, Kerry. Happy investing to you and your listeners.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.